Are you ready to jump into the real estate market in Denver, Colorado, and just are a little bit confused on some different terminology, the types of loan that are being offered? Well, today in this video, we're going to be discussing the different type of residential mortgages that you can qualify for when you're looking to purchase a home. It's Shelbi, aka the Real Estate Diva, broker owner of the R.E.D team in Denver, Colorado, and your tatted agent. Today in the video, we're going to be talking about the different kind of residential mortgages that you can qualify for or apply for when you're looking to purchase a home. I just want to give you a little bit more education on the lingo that is used, and so that you can help to understand and differentiate between all of the mortgages that are available to you. But first, I want to do some housekeeping. First, I have to apologize to you guys. I know when I initially launched my channel, I said I would be putting out videos twice a week on Mondays and Wednesdays, and my schedule has definitely been off. Guys, I just have to be real with you. This whole YouTube video recording thing is very new to me, and it can be quite overwhelming. But I pray going forward this week that I will be on a set schedule, and I will be bringing you videos on Mondays, Wednesdays, and Fridays. So guys, please just bear with me, and I will continue to bring you helpful information about the real estate market and all things Denver. So without further ado, let's get into today's video. First mortgage we're going to be talking about is a conforming mortgage, which is a conventional loan that is not backed by any government agency. Also, the conforming mortgage must meet borrower limits as set forth by the Federal Housing and Finance Agency. For 2023, that borrower limit is going to be $726,200. In addition, you need to have at least a 620 credit score and a debt-to-income ratio between 36 and 50%. You must put down 3%, at least 3%, for this loan. If you do not have 20% to put down on a conforming mortgage, you will have private mortgage insurance. But once you get to 20% equity in your house, you can cancel that private mortgage. Loan number 2 is going to be a jumbo mortgage. A jumbo mortgage is a non-conforming mortgage and another type of a conventional loan. You would use a jumbo mortgage if your loan limit is going to be higher than the limit of $726,200 as set forth by the Federal Housing Finance Agency. In addition to the jumbo mortgage, it is going to be a little bit stricter on the eligibility because the lender assumes more risk. So you will definitely need a higher credit score, lower debt to income ratio, and a bigger down payment. Mortgage number 3 is going to be an FHA mortgage, which is the most common mortgage that we've seen most people qualify for. An FA mortgage is a federal government agency backed mortgage. There are 3 types of federally backed government mortgages, one being FHA, VA, and USDA. And this means that if the borrower should default on the mortgage, the government agency will pay back the lender. The requirements for an FHA loan are 3.5% down, a credit score of at least 580, and a debt-to-income ratio of 43%. With an FHA mortgage, you will have to pay a mortgage premium insurance, and that is going to be 1.75% of the mortgage that you will pay at the time of closing, and then an annual premium of anywhere of 0.45% to 1.05% over the life of the loan. Mortgage number 4 is a VA mortgage. VA mortgage is a federal government-backed mortgage by the U.S. Department of Veterans Affairs and is for military families. VA mortgage loans come with a slightly lower interest rate. You must have a 660 to qualify for a VA loan and a 41% debt-to-income ratio. You don't have any down payment with a VA loan, and you have no mortgage insurance. However, there is a fee for using your VA loan. The first time you use your VA loan, the fee is 2.3% of the amount borrowed. And if you've used it before, that fee goes up to 3.6. But you can lower that fee by putting money down. Mortgage number 5 is the USDA mortgage. The USDA mortgage is backed by the U.S. Department of Agriculture and is geared towards families that are low to middle income looking to purchase a home in any rural or suburban area. The USDA mortgage income limits are vary by where you're located at in the U.S. Just like with the VA mortgage, the USDA mortgage, you do not have to pay a down payment. However, you will pay mortgage insurance, and that mortgage insurance should be less than what you pay for FHA mortgage insurance. You will pay 1% of the principal interest at the time of closing, and then you will pay an annual premium of 0.35% for the remaining principal balance. Loan number 6 is a fixed rate mortgage. When it comes to locking in your interest rate, you will either select from a fixed rate mortgage or an adjustable rate mortgage. With a fixed rate mortgage, you lock in your interest rate for the duration of the loan. Although interest rates increase and decrease over time, you will still pay over a 30-year period what you paid for your first mortgage payment. Mortgage number 7 is an adjustable rate mortgage, or ARM. With an ARM, you keep the interest rate for the first few years, and then your rate adjusts periodically over time. For example, if you have a 5-in-1 ARM, your introductory period is for the first 5 years. And after the first 5 years, your mortgage rate will either increase or decrease every year after. Loan number 8 is a construction loan. You may apply for a construction loan if you're building a house and you need to finance permits, supplies, labor, etc. With a construction loan, it's normally short term, like 1 year, and it normally carries higher interest rates. You may choose to pay off the construction loan once construction is complete, or roll it over into a more traditional mortgage. If you purchase a home that needs significant changes, renovations to it, you can apply for a renovation loan. With a renovation loan, the money you borrow is rolled into your mortgage. Mortgage number 9 is a balloon mortgage. With a balloon mortgage, you still make your monthly payments just as you would with any other mortgage, but you do it over a 5-year period or so. And with a balloon mortgage, the interest rates are normally lower, but it can be a lot riskier. If you do decide to get, or you're thinking about what the benefits are of a balloon mortgage, is if you plan on moving out of your home or refinancing your home before the initial payment period ends, then a balloon mortgage might be the way for you to go. Guys, the last mortgage, mortgage number 10, is an interest-only mortgage. With an interest-only mortgage, you borrow the money just like you would with any other type of mortgage, but you only make monthly payments on the interest. With an interest-only mortgage, you will not see your balance go down because you're only paying interest. So keep that in mind. And once your initial period of making interest-only payments is over, you have several options available to you. You can pay it all in full. You can refinance it into a more traditional loan that we talked about earlier, or you can start to make payments to include principal and interest. But remember that those payments are going to be higher than what you have been paying previously. All right, guys, that's it for today. I hope you found this information helpful. Once again, if you have any questions, please feel free to drop a comment in the comment section below, or check out my contact information and get in touch with me, and we can talk in more detail about maybe which mortgage might be best for you depending on your situation. Lastly, please don't forget, if you like this video, please give it a thumbs up. Subscribe to my channel, and don't forget to hit that notification bell so you can be up to date on all of my current content. Thank you for tuning in today. I hope you guys have a great rest of the day. Peace and blessings, and remember, keep smiling.